Hello and welcome to a brand new edition of Money, Money, Money. And this week our topic is very interesting. You know, when we talk to advisors about our investments, very often we are told stay invested through the business cycle. When we talk of fund managers and, experts themselves, they say judge them according to the number of business cycles they've seen. You know, this so-and-so has seen one cycle, another person has seen two cycles. So what exactly is a business cycle? Joining in to explain that is Aashish Somaiyaa, ED and CEO at WhiteOak Capital Management. Aashish, thanks very much for joining in. You know, I myself am so intrigued by this because I'm keen to learn it myself. So I want to begin by asking you that what exactly do you mean when you refer to a business cycle, and, why is it so relevant to investors?
Yeah, I think, basically, obviously when we buy businesses, when we invest in businesses, of course, through the equity stocks, clearly we are betting on the business prospects. And as you know, business tends to be cyclical to the extent that a business is a participant or an economic participant. To that extent, obviously, businesses tend to be cyclical. Now, needless to say, some businesses are not as cyclical, or some are actually not cyclical at all. And some businesses are deemed to be cyclical. So when we say cyclical, obviously what it means is that it's a whole trajectory, in terms of how the demand plays out. So generally speaking, what you might actually encounter is that when the economy is doing extremely well, you will find that demand for a lot of goods is actually literally, flying. There is a very heightened demand for a lot of goods. Obviously, when there is a high demand for goods, the prices kind of tend to go up. When prices keep going up despite higher demand, obviously then the businesses are forced to expand their capacity or their ability to produce more. Eventually, what you will find is that the capacity or the ability to supply is probably higher than the demand at some point in time. And then obviously when the demand doesn't keep up with this enhanced supply, you will find that businesses are forced to cut prices. Mm-hmm. So when you see this whole cycle playing out of demand followed by rising prices followed by capacity addition resulting in supply exceeding demand. When supply exceeds demand, obviously the prices need to be cut. And then you go through the whole, but on the other hand, like I mentioned at the onset, that some businesses are not cyclical. So for example, if you look at FMCG goods, stuff like soaps and stuff like, our toothpaste and shampoos, they are, items of daily consumption are not thought to be cyclical. But on the other hand, stuff like, say, commercial vehicles, capital goods, a lot of these which are deeply linked to the economic expansion, these are the ones which tend to be cyclical. Now, different industries have different cycles. For example, real estate and construction is thought to be a deep cyclical, meaning that the cycles are very long drawn out and the boom bust is significantly pronounced. On the other hand, stuff like automobiles is thought to be not as cyclical. Within automobiles, again, there is passenger vehicles and then there is commercial vehicles. It is believed that commercial vehicles are a bit more cyclical and the cycles are more long drawn out than passenger vehicles. So cyclicality in its, it's a natural phenomenon which is interspersed with, economic activity, and at the same time, economic activity accentuated by human behavior. So, it's difficult to define how long a cycle would be. It clearly depends on what type of goods and what type of industries we are speaking about.
Okay, so this whole thing which you spoke about how it picks up depending on the demand. So there's a lot of factors which are external to that business, right, which influence it. So periods of tezi and mandi. Are they both part of the same cycle? And, how would you measure a business cycle? I mean, in years, is it, like you said, difficult to define how long it may last? But, can you give us a sense of how long a cycle may last? Is it, a few years, 2, 3, or could it be as long as 8, 10 years?
Yeah, so it could be like, say, for example, generally it is believed that a typical economic cycle, like you rightly put, I also don't know the exact English words. Maybe here usage of Hindi is a bit more effective in terms of expression. So you're right in using Teji and Mandi. Teji is actually a period of high pace in economic growth, and Mandi is obviously the, word for a slowdown. So, generally speaking, it is believed that, 3 to 5 years is a business cycle, meaning that, when you talk about economies, generally it is believed that, 3 to 5 years is a period of expansion, followed by a year or two of slowdown. Typically because what would happen is why a slowdown inevitably follows a period of expansion is because periods of expansion are always, inflationary, meaning that whenever there is an economic expansion, like I mentioned earlier, demand would go up. With rise in demand, prices would go up. When prices go up, it is always followed by inflationary trends, right? And when inflationary trends abound on the margins, some people start feeling poorer, which means that through usage of fiscal policy and through usage of monetary policy, the government, the central actors like the government and the RBI are clearly forced to tame inflation. And how would they tame inflation? They would tame inflation by raising interest rates and by making money more difficult to access, which would ultimately result in demand tapering off and hence inflation also cooling down. But as you will appreciate, these things cannot be exactly calibrated.
Yes.
It's not like the steering wheel or the accelerator of our car, whereby you can exactly calibrate in terms of how much you want the economy to slow down or how much you want to control. So clearly, at the bottom of the cycle, when all these central actors are trying to engender a recovery in the economy, they overshoot on the upside. And clearly on the at the top, when they're trying to engender a control on inflation and trying to steer around for a bit of a cool off, they kind of tend to overshoot on the downside. So business cycles, economic cycles are thought to be 3 to 5 years of expansion and then maybe a year or two of, contraction or slowing down. That's typically how it is thought through. But, when you look at sectors like large sectors like real estate, where projects, sales cycles, project cycles, those, projects take 4 or 5 years to make. And then, a couple of years to sell and then, deliver and stuff. Plus, it's not a consumer item really. People buy real estate depending on their sense of confidence or optimism for the future, depending on their own personal, job prospects and growth prospects. So generally, if you talk about the economy on an average, while people think that a 3 to 5 year is a business cycle, if you look at, say, a sector like real estate, which has long sales cycles and long project cycles, people do believe that it is 8 to 10 years. So depends on what part of the economy you're speaking about. Also, let me tell you that in the last few years, these central banks like the Reserve Bank in India or say the Federal Reserve in the US, in the last few years, by usage of monetary tools, for example, usage of interest rates, usage of liquidity, usage of different parts of the yield curve and interest rates, central banks have started to, like you would have a music conductor, central banks have started to calibrate economic growth and slowdown almost as a music conductor would kind of calibrate how the opera or how the orchestra actually plays out. So from that perspective, it has been observed, and in the last 15-20 years, it has happened that the cycles have become shorter and shallower. So you don't see a deep bust, and on the other hand, you also don't see a heightened boom. Like, right now is a great point in time where people are observing very closely that what does the Federal Reserve do to control the economy or to calibrate or bring it to a calibrated slowdown.
Yeah, so basically with so many cycles under their belt, they're also getting better at dealing with it, right? But, Aashish, I understand that it's not an exact science, right? But if you can give us a sense of the previous cycle, just so that we know where we are in the current cycle. I mean, what was the previous cycle? How did it play out? And where exactly are we in the current cycle that's ongoing?
See, in my, in recent times where one has seen a perfect cycle playing out. See, for example, if you say 2013-14 onwards till 2019-20 or even 2021, for prolonged points in time, frankly, we didn't know where we were in the cycle. And that was because 2013-14 till about 2020 was punctuated by significant number of interventions, structural interventions in the economy. So I dare say that in the last 7-8 years, things have been complex because probably a cycle never really played out. We just saw some kind of recovery and a setback and a recovery and a setback. We never really saw a cyclical, like a trough and a crest kind of playing out. But since you're asking for an example, I would say that the period from say 2000 to 2002, when we saw a significant decline in economic activity and a slowdown, and then from 2003 it bottomed, and 2007-8 we kind of saw significant economic recovery, almost like a crescendo in 2007-8. And then see, there is always different reasons. In 2008, for example, the global financial crisis and what happened in US, it kind of resulted in some bit of impact on the economy because of global macros. So I would say 2000 to 2003 was more like top to bottom, from a crest to a trough. 2003 to 2007-8 maybe like a trough back towards the crest, and then from 2008 till about 2010, maybe again like 2009 end, actually more like a bottoming down. And you would see that the stock market cycle and the economic cycle in some sense tends to coincide. Of course, there are leads and lags.
Yes.
But what happened between 2000 and 2010 was a great example. Like I said, 5 years of expansion, and on either side, you saw a couple of years of slowdown.
Understood. So we have a fair idea of how things move in a business cycle. We're going to take a quick break now, but on the other side, we'll tell you why it's important to stay invested through the business cycle, and how do you determine where your investments are vis-a-vis the business cycle. So Aashish is going to stay on with us and explain all of that on the other side. Stay tuned. Welcome back to Money, Money, Money. With us is Aashish Somaiyaa, ED and CEO of WhiteOak Capital Management, and we're talking about what exactly is a business cycle and why it is relevant to retail investors. So Aashish, we've spoken a fair bit about what is a business cycle. Now, if we sort of take it in the context of investing in, say, a mutual fund, right? So if we talk about a particular fund, how can we tell, where in the business cycle that fund is currently vis-a-vis the investment? Or, if I'm looking to enter into a fund, how do you determine what is the cycle that it's following?
So, I think extremely complicated. One of the sad parts or the unfortunate parts, at least from my perspective as I understand it, one of the unfortunate things is that, a lot of these things you will only know in hindsight. Because, say, for example, in 2006, I'll give you an example. In 2006, there was a big crash. In May 2006, there was a big crash in the markets, right? And, willy-nilly, whenever there is a big crash in the market, it is always substantiated with some or the other, reasons or economic prospects, or, a couple of quarters of bad results, or maybe some inflationary trends getting accelerated. So every time the market falls, there is some or the other explanation. But let me assure you that somewhere in mid-2006, most people would have concluded that we have run the course, the cycle has ended, and I think we are heading for a slowdown. But not really. From 2006 till early 2008, we saw the economy really actually accelerating. A lot of infrastructure investments, a lot of noise about economic prospects. So what happens is that generally you are able to explain fully well only in hindsight, and more often than not, it's very, very difficult. Like I mentioned, between 2014 to 2020, extremely difficult to figure where exactly we were in the cycle. In fact, there were at least 2 or 3 instances when we saw Nifty's earnings per share and corporate performance accelerating, and then in the end of 2015, we see a commodity price crash. In 2016, and we saw demonetization. In 2017, RERA and GST. 2018, ILFS default. 2020, COVID. So period from 2014 to 2020 is a great example where you just couldn't figure out whether a full cycle was playing out or not. whether it was some cyclicality, but interspersed with too many interventions in the economy. So I would actually forewarn all our viewers that while we are explaining what a business cycle means and usually how it plays out, I can also tell you that when you're actually living through it, it's extremely difficult to figure where you are. Also keep in mind that, like today, I mean, the last few months is a great example. Our corporate performance and our economic performance was actually accelerating. But, we are seeing oil prices going up. We are seeing inflationary trends. We are actually thinking whether our economic cycle, is it being disrupted by the influence of global factors like a war in Ukraine and as a result, accelerating commodity prices, oil prices, and fears on inflation. So look, today you can clearly see that some of this inflation is imported. It probably had nothing to do with our economic cycle, but it's enforced upon us by external macros. Will that shorten our period of economic expansion? Will that curtail our cycle? So the long story short is that it's always very difficult to understand where we are in the cycle. And most of the time we're able to explain only in hindsight. So investors are best advised, not to really identify funds or try to bet on funds, assuming that they are adept at timing the cycle. Because these, businesses, at least in my opinion, businesses are best bought bottom up for their individual fundamentals. And of course, one needs to be mindful of macroeconomic factors. But I think trying to predict macroeconomic factors is like a coin toss.
No, Aashish, I don't mean to ask it in the context of trying to predict the cycle. What I meant to ask is that, we're advised all the time to stay invested. If you're in a fund, stay invested through the business cycle to reap the entire benefit, right? But if we don't know where we are, how do we know how to stay invested? And also because, in your portfolio, you're marrying many different funds. Depending on, what is the sector weightage of each fund, they will have, some overlapping cycles, some probably extended. So how do you marry different funds together?
So yes, I think from an investor's perspective, it becomes very challenging because most fund managers do have a set of beliefs. In fact, in our industry, some managers believe in timing the cycle, and they would believe that, they should be invested in defensive sectors at the peak of the cycle, or not so cyclical, non-cyclical or acyclical kind of, or counter-cyclical kind of sectors at the peak of the cycle. And they believe that they have the ability to invest in cyclical sectors at the bottom and, kind of ride up the entire wave from the trough to the crest. So there are managers who believe, they are cyclical or they are contrarian, or maybe they are value buyers. So there are managers who believe that they can do that. We, for example, if I speak for WhiteOak for a moment, we don't have any confidence in anybody's ability to time these cycles, and definitely not ours, but definitely not anybody else's as well. So we will actually run a portfolio always, which is well balanced for counter-cyclical as well as pro-cyclical stocks. So we, like I mentioned, we will buy businesses purely on individual merit. And while we know that the macro cannot be timed, we at least believe that it should be mitigated or neutralized. Now, coming from an investor's perspective, as to, why are investors advised to stay through the cycle? That is precisely because of what I said, which is that it's very difficult to time it. So it's best that you have a 5-year, 7-year time horizon, which means that even if you enter at an inopportune time, if you stayed long enough, then a crest followed by a trough eventually will be followed by a crest. So if you've stayed long enough, everybody cannot enter at the bottom and exit at the peak. Plus, this whole matter is complicated because stock markets have lead and lag vis-a-vis the actual economy. So everybody cannot enter at the bottom and exit at the peak, which means that a lot of us will get our timing to be inopportune. That is why it is also said that timing is next to impossible. And that's why it's also said that time in the market is more important. This is why investors are always advised to remain invested through the cycle. If there are any inadvertent or any inopportune economic developments, if you stay longer, you kind of ride over those phases. So investors are best advised to have a 5-7 year kind of time horizon so that they are not caught with the short end of the stick. On the other hand, like I said, some managers do communicate that they have the ability to time these cycles. If you are convinced about their abilities, then maybe you can bet on that. Otherwise, bet on their ability to time the cycle, or bet on their ability to time the right sector at the right stage of the cycle. If you're convinced, you can bet on that. Otherwise, we don't believe in it. So the best option is to stay invested for long and to run a balanced portfolio, which is not betting on any phase of the cycle.
Absolutely. And, I tend to agree with you as well. Unless an investor themselves have the ability to sort of know what is going on in the overall economy, you may want to go with, a portfolio that's well balanced, and at least one part of the portfolio should always be performing. And like Aashish said, this is why we as investors are advised to remain invested for longer periods so that any sort of negativity can be minimized, and we also get the benefit of compounding and of having seen our wealth grow. Aashish, thank you very, very much for joining in to explain the business cycle, which, while it may not be an exact science, I think Aashish has done a pretty good job of explaining what the many variables are. So with that, we're going to wind up on Money, Money, Money. Thank you very much for watching, and we'll see you again next week.